Today, we're going to unpack the wild story of a crypto token called River. We're talking a spectacular rise and an even more spectacular crash. And trust me, it is packed with warning signs that anyone in crypto really needs to know about.
So picture this. It's January 26th, 2026. The River token is absolutely flying, hitting an all-time high of almost 88 bucks. The hype was real, and you can bet it felt like people were getting rich overnight.
Okay, now fast forward to today. That exact same token, it's trading for around $7.30. Yeah, just a brutal, staggering collapse. So the big question is, right, how does this even happen? How does a token just evaporate more than 90% of its value in a matter of months? Well, let's dive into the data and see if we can piece this story together. All right, so before we can get into the crash itself, we have to understand the sales pitch. What exactly was River? What was the big idea that got so many people to buy in? So on paper, River was what's called a DeFi protocol. You can basically think of it as a universal translator for crypto. It was a bridge, right? Designed to let you move your money and your assets between different blockchains without all the usual headaches. A really powerful idea if they could actually pull it off. And listen, this wasn't some tiny, obscure project hiding in the corner of the internet. It launched with some serious backing. We're talking an $8 million investment from Tron DAO. And the plan was to operate on huge networks like Ethereum and BNB chain, so you can see why people were excited. On the surface, this thing looked totally legit. But, and this is a huge but, despite that shiny exterior, if you actually dug into the on-chain data, the public record of every single transaction, there were some massive warning signs, and analysts were flagging these long before the whole thing came crashing down. So what were they? What were the clues that this collapse was on the horizon? Well, as it turns out, the evidence was hiding in plain sight for anyone who actually knew where to look. Okay, here it is. The first and honestly the biggest red flag, which sources like Cryptopolitan pointed out, was just extreme centralization. See, a giant chunk of all the River tokens, well, they weren't owned by the public. They were all concentrated in a few wallets controlled by the project's own team. And that gives them an insane amount of power to control the price. And when you visualize that risk, it just becomes crystal clear. Look at this. On just one blockchain, the base chain, a single address held a ridiculous 88% of the entire River supply. I mean, come on, that is not decentralization. That is a ticking time bomb, plain and simple. It means one person or group can crash the whole market whenever they feel like it. And the red flags just kept piling up. Analysts found these weird clusters of wallets that all seemed to be connected, which suggest insiders were just scooping up tokens on the cheap. At the same time, the biggest investors, we call them whales, they were cashing out for millions of dollars while the price was still high. And to top it all off, more than half of the market's liquidity, that's the money that actually lets you trade, it was coming from one single source. If they decide to leave, the whole market just freezes up. So when you pile up all these serious problems, yeah, it's not a huge shock what happened next. Let's take a look at the market's absolutely brutal verdict on River today. So after the price completely cratered and all this info started coming out, how did traders react? I mean, what's the general feeling out there now? Is there any chance of this thing coming back? Well, the mood out there is grim. The market sentiment is bearish, which just means pretty much everyone expects the price to keep dropping. You look at the fear and greed index, and it is screaming extreme fear. Even key technical signs like the 50-day moving average are just flashing a giant sell signal. To put it simply, the market has lost all faith. Okay, so looking back at this whole mess, the important part isn't just pointing fingers. It's really about what we can all learn from this. Because this, my friends, is a classic cautionary tale for the modern age. And here's the main takeaway. The story of River, it's not really that unique. It is a textbook example of why that phrase you always hear, do your own research, isn't just some catchphrase. In a market like this, it is your absolute best defense against getting wrecked. So what does that research actually look like? Well, using River as our guide, here are 4 critical questions you should always ask. First up, who's actually holding the tokens? Is the supply all concentrated in a few hands? Second, what are the big players, the whales, doing? Are they dumping their bags while they're telling you to buy? Third, where's the liquidity coming from? Can the market even survive if one big player packs up and leaves? And finally, and maybe most importantly, question the hype. Does the real data on the blockchain actually support the story they're trying to sell you? And that really leaves us with the million-dollar question, doesn't it? In a market that is so often fueled by hype and FOMO, the fear of missing out, the most valuable skill isn't picking the next big winner. It's learning how to spot the traps. Learning to see past all that noise and just analyze the cold, hard data is really the only way you're going to separate real promise from hidden peril.